for 5 minutes.
Thank you, Madam Chair, and Chair Powell, good to see you again. I wanted to follow up on an exchange that we had back in March, this past March, where we were discussing the parameters highlighted in the Federal Reserve Board's legal opinions that outlined how asset managers can operate without being deemed, quote, in control of a regular bank or a bank holding company. Letters from the Fed's legal division also include certain commitments made by these asset managers to ensure the same result. However, it's no secret that this percentage of ownership held by asset managers will constantly fluctuate as shares are purchased and sold on a daily basis. With the ever-changing ownership structure, someone must ensure asset managers are complying with not only these opinion letters, your opinion letters, prepared by your own staff, but also with the statutory and regulatory framework that the letters outline. So, Chair Powell, I'd like to ask you again, is the Fed taking any steps to assess or monitor whether Vanguard, BlackRock, and others are complying with these commitments made in November of 2019 and December of 2020, respectively? Is that ongoing?
Can you give me 1 second?
Okay.
Sorry, that's a very specific question. I didn't know the answer, but so I would say this: we're broadly monitoring the situation. I don't know that we have a particular focus on the asset managers.
Okay. Well, those were opinion letters put out by your folks, outlining very specific things that could or could not happen. And back in March, when I brought this up, and now again today, I'm looking to find out who's actually minding the store on that. And that, so it's a little concerning that we don't have an answer on that. I guess we'll continue this conversation, and maybe you can answer this: what division at the Fed is responsible for reviewing and monitoring an asset manager's compliance with these opinion letters issued by the board's legal division?
So it would be the General Counsel's office. We don't have any reason to think that they're not in compliance, by the way.
But nobody's checking.
Well, we'll check, but
okay.
I think we know what we're going to find.
I'd like to know what you're going to find, not what you think you're going to find on that. So thank you. I'll be following up with a letter to include some more detailed questions on the topic, and I assume you will commit to getting us a timely answer into that.
I think we offered your staff a briefing on this, by the way.
Yes, and there was a briefing, and let me be clear. Appreciate the cooperation that has happened. We've also had some other briefings. There's been a number of briefings that we've requested, and frankly, your division of government has been more helpful than others, shall we say. So I'm going to quickly pivot to a committee's investigation of the SVB, the Silicon Valley Bank failure. Your staff has been working to get us some answers on our outstanding questions. You did your own report. Now it's our turn. And can you appreciate that our committee is conducting its own independent review of what happened in March?
Yeah, very much so.
Okay, thank you. Will you commit to producing the interview notes and allow us access to the staff who participated in the interviews conducted for the Fed's own internal review of the bank supervision report?
I'm not in the middle of that discussion. I don't know where that stands, so I don't want to make commitments that I can't back up. So I'll be happy to understand where that discussion is and try to work with you.
We're going to be following up for sure on that. When Vice Chair Barr concluded that a, quote, culture shift, his words, happened, do you know if the Fed officials spoke with examiners of other banks, or was this conclusion made solely after the review of SVB? In other words, did they find some systemic problem throughout the Fed?
The thing is, I didn't play any role by design in the preparation of the report, and I'm reluctant. I think I know the answer, but I don't want to guess. So we can give you a 100% clear answer on that, but okay. I'd rather not speculate.
All right. Well, along with the FDIC and Department of Treasury, you invoked the systemic risk exemption, the SRE, for both Silicon Valley and Signature Bank, guaranteeing all depositors would be made whole. For example, regulators could have used orderly liquidation authority, a very tool Dodd-Frank was intended to resolve the, quote, too big to fail institutions while protecting taxpayers. Why was the decision to use SRE made, and do you think that is that we've now lowered the bar to use SRE in future bank failures?
I hope we don't have to face that question again.
We all do.
As long as I live.
But has a new bar been set?
I would
No
say
pun
this,
intended.
though this happened with no warning on in the middle of the night Thursday night, and less than 12 hours later, we're on the phone with the FDIC, and they're deciding to close the institution and to haircut uninsured depositors. So it was an emergency situation over that weekend. We could see that there was an electronic run building up, and we did what we had to do to address that, and I think successfully.
Gentlemen, time has expired.